Hey everyone, welcome back to Corporate Decoder, the place where we take massive financial documents and make them actually understandable, or as understandable as a report filled with numbers about municipal bonds can be. This time around, we are diving into Fidelity Court Street Trust report for the period ending the 30th of November 2025. So what is the big story here? Well, we are looking at two funds, Fidelity New Jersey Municipal Income Fund and Fidelity Connecticut Municipal Income Fund. These are essentially investment funds that pool money to invest in municipal bonds. Think of them as a way for regular folks to invest in bonds issued by states and cities to fund projects like road schools and hospitals, all without having to buy each bond individually. The main goal is to provide income that is usually free from federal taxes. Let's start with the Fidelity New Jersey Municipal Income Fund. For the year ending the 30th of November 2025, this fund is showing some interesting performance. Their reported costs for a hypothetical $10,000 investment were about $45. Now that does not sound like a lot, but it is what these costs represent that could raise an eyebrow. Essentially, it is 0.45% of that investment. Over time, these small percentages can add up. The report mentions that US tax-exempt municipal bonds had a solid gain boosted by a late period rally driven by the Federal Reserve's interest rate cuts, moderating muni supply and firming demand. This is good news for bondholders. However, not everything was rosy. The report notes that an underweight in security selection among bonds backed by the Port Authority of New York and New Jersey contributed to performance versus the benchmark index for the fiscal year. This means that the fund managers did not invest as much as they could have in these specific bonds, or they picked bonds that did not perform as well as others in that category. On the flip side, selection among bonds backed by the New Jersey Transportation Trust Fund Authority also helped performance. Another positive was the fund's positioning in the yield curve, especially its underweight in bonds 20 years and longer. This means they held fewer of the longer-term bonds that can be more sensitive to interest rate changes. Looking at where the money is invested, we see that general obligations make up about 38.3% of the fund's net assets. Transportation bonds are the next significant chunk at 26.8% and education at 15.1%. These are the main sources of revenue for the fund. The quality diversification is also key. Most of the fund's assets are in AA and rated bonds, which are generally considered safe. Only a small portion, 0.8%, is in BB rated bonds, which carry more risk, and 1.1% is not rated at all. This indicates a focus on more stable investments. Now let us switch gears and look at the Fidelity Connecticut Municipal Income Fund. For the year ending the 30th of November 2025, the costs for a hypothetical $10,000 investment were about $47 or 0.46%. Very similar to the New Jersey Fund. Similar to the New Jersey Fund, the report states that US tax-exempt municipal bonds experienced a solid gain. But again, there were some specific areas that dragged performance. For the Connecticut Fund, holdings in Bristol Hospital, which faced increasing costs and funding challenges, detracted from performance. Also, an underweight in bonds backed by the state of Connecticut hurt the fund's relative performance. Their positioning in the yield curve also hindered performance this period, with an overweight in longer-term bonds and underweight in shorter-term securities. However, similar to the New Jersey Fund, pricing factors meaningfully contributed to relative performance. This highlights how the way bonds are valued can impact a fund's reported performance. When it comes to asset allocation, the fund had no major changes. The quality diversification here shows a heavy concentration in AA-rated bonds at 45.2%, followed by A-rated bonds at 20.4%. They also have a notable portion in BBB-rated bonds at 11%, and some in BB-rated bonds at 3.1%, and a small slice, 3.2%, is not rated. Now let us talk about the money changing hands behind the scenes. For the fiscal year ending the 30th of November 2025, the audit fees for the Connecticut Fund were around $46,500, and for the New Jersey Fund it was about $42,900. These are the costs directly related to the audit of each fund. You can see these figures are pretty consistent year over year. The report also details audit-related fees, tax fees, and all other fees. These combined with fees billed by PwC, which is PricewaterhouseCoopers LLP, represent the significant costs associated with ensuring these financial statements are accurate. For example, the total fees billed by PwC for services to the funds and related entities were over $13 million for 2025. This is a substantial amount of money just for auditing and tax-related services. Looking at the financial statements themselves for the Fidelity New Jersey Municipal Income Fund for the year ended the 30th of November 2025, we see the impact of these investments. The total investment income was $21,27,0124. After expenses of $2,613,199, the net investment income was $18,656,925. This is the profit generated from the interest earned on the bonds. The fund also saw a change in net unrealized appreciation of $1,797,513, meaning the value of their holdings went up. This resulted in a net increase in net assets from operations of $2,098,633. The total net assets of the New Jersey Fund at the 30th of November 2025 were $640,448,074. The net asset value per S-Share was $11.73. This represents a solid increase from the previous year where net assets were $555,376,587. This growth is driven by both investment performance and new money coming in from investors. For the Connecticut Fund, the picture is similar but on a smaller scale. Investment income was $10,150,787, with expenses totaling $1,447,871. This yielded a net investment income of $87,02916. The change in net unrealized appreciation was $1,770,804. The net increase in net assets from operations was $1,023,2669. The Connecticut Fund's total net assets at the 30th of November 2025 were $329,949,030 with a net asset value per S-Share of $11.10. This also shows growth from the prior year when net assets were $317,136,142. Finally, let us touch on the management fees. The report details the rigorous process the Board of Trustees goes through to review and approve the investment advisory contracts. They look at the nature, quality, and cost of services provided by Fidelity Management and Research Company LLC and its affiliates. This includes comparing fees to industry peers and considering the profitability of Fidelity. For both funds, the maximum management fee rate is 0.43%. While this sounds small, it is a crucial part of ensuring that the fees paid are fair and reasonable. The board concluded that these arrangements were fair and reasonable and renewed the advisory contracts through September 2026. For the Connecticut Fund, the management fee income was $134,034, and for the New Jersey Fund, it was $2,517,722. Now, for my take on this report, both of these funds are essentially investing in the same kind of assets, municipal bonds, which are generally considered safer investments than stocks. The performance for both funds seems to have benefited from a favorable interest rate environment and a general rally in the municipal bond market. However, both funds experienced some underperformance due to specific security selections or holdings in certain sectors, which is quite common in active management. The expense ratio is quite competitive for the industry generally in the 0.45 to 0.46% range. The overall financial health of both funds appears stable with growing net assets. The main risk for these types of funds always lies in interest rate changes and the creditworthiness of the issuers. However, the portfolio diversification into general obligations, transportation, and education bonds helps mitigate some of that risk. What is notable is the heavy concentration in certain types of municipal bonds. For example, the New Jersey Fund has a huge chunk in transportation, and the Connecticut Fund has a large exposure to education and special tax bonds. While this is in line with their investment mandate, it does mean that any significant negative developments in those specific sectors could impact the funds more profoundly. In conclusion, these reports from Fidelity Court Street Trust show two well-managed municipal bond funds that are navigating the market with a focus on quality. They are performing reasonably well given the market conditions, and the board's oversight of advisory fees and contracts appears thorough. The main takeaway is that while municipal bonds offer tax advantages and relative stability, investors should always be aware of the specific holdings and potential risks within any fund. So, what is your take on these municipal bond funds and their performance? Do you invest in municipal bonds yourself? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And as always, check out the Discord link in the description for more community discussions. Thanks for watching, and I will see you on the next episode of Corporate Decoder.